It's 8:29 a.m. Eastern on the first Friday of the month. You're staring at the URUSD chart. The price action is eerily still, and the clock is ticking down to the most volatile minute in Forex. This stillness is a symptom of the liquidity vacuum. Seconds before the non-farm payroll report drops, big banks and liquidity providers pull their orders from the book. They have no interest in being the counterparty to a massive, unpredictable news spike. At 8:30, the numbers hit the wire. The headline NFP prints, and it beats expectations by 50,000 jobs. Retail logic suggests a stronger economy. Buy orders for the US dollar flood the market as traders chase the headline beat. But the initial spike often reverses just as quickly as it began. The US dollar can peak for mere seconds before crashing back through its starting price in a violent whipsaw. This reversal is made lethal by widened spreads. Because liquidity is so thin, the gap between the buy and sell price can blow out instantly. This causes stop losses to trigger even if the actual price line never touches your level. Trading the raw NFP headline right at 8:30 without understanding these order book mechanics turns retail traders into exit liquidity for institutional algorithms. To understand why the market often reverses on a good jobs report, we must look past the trading terminal and focus on the Federal Reserve. The Fed's focus has evolved. They now hunt for signs of labor market softness to balance their dual mandate of stable prices and maximum employment. Bad news is often welcomed. A weak jobs report signals cooling, justifying interest rate cuts and fueling a rally in stocks. Conversely, a strong jobs report is a threat, giving the Fed cover to keep rates higher for longer, slamming the door on cuts. Modern NFP trading is an exercise in calculating the Fed's permission to lower rates, rather than a broad assessment of economic health. The market prices in the consensus forecast days in advance. If banks expect 200,000 jobs and the report aligns with that number, the market reaction is negligible. The true volatility comes from the expectation delta, the gap between the prediction and the reality. That delta often hides in revisions. A headline beat is frequently negated when the previous month's numbers are quietly revised downward, revealing a net loss of momentum. However, one metric inside the report overrides the job count entirely: average hourly earnings. If people are earning more than expected month over month, the Fed views that as sticky inflation. High wage growth signals a potential wage price spiral. This forces the central bank to keep rates high and the US dollar strong, regardless of how many new jobs were actually added to the economy. A miss in this wage data acts as the ultimate inflationary canary. It is often the reason a headline jobs beat reverses into a massive sell-off within minutes. Because the Friday NFP report is so complex, traders spend the entire Wednesday before the release trying to forecast the outcome. Many rely on the ADP National Employment Report, but its correlation to the official government NFP is statistically weak. They regularly diverge by over 100,000 jobs, making it an unreliable proxy. Institutions use a more consistent leading indicator, the 4-week moving average of initial jobless claims. It's a real-time smoke detector. Watch for a specific pattern. 4 consecutive weeks of rising claims drastically increases the mathematical probability of a headline NFP miss. Tracking these weekly claims allows you to build a logical, data-backed bias days before the chaos of the 8:30 a.m. news hits the wire. It's now 8:35 a.m. The initial high-frequency algorithms have exhausted themselves, the spreads are normalizing, and the liquidity grab is over. This is the snapback. Smart money has finished digesting the revisions and the wage growth data, and the true fundamental trend of the day begins to take shape. Professional operators navigate this window using an if-then matrix. By mapping out specific logical triggers in advance, you remove emotional hesitation from the trade execution. Using this matrix effectively means waiting for the first 15-minute candle to close. This confirms that you are riding a real fundamental deviation rather than the initial 8:30 whipsaw. Surviving the non-farm payroll report requires shifting from a reactive gambler to a disciplined operator. By focusing on the expectation delta and the Federal Reserve's reaction function, you can turn these high volatility events